Good morning and welcome to the ParkBridge Wealth Management Spring Webinar Series. This program is entitled Hot Topics in State Tax Residency, Audit Enforcement and Wealth Taxes. As always, my name is Jonathan Shenkman. I'm the President and Chief Investment Officer of ParkBridge Wealth Management. In that role, I serve in a fiduciary capacity to help my clients achieve their financial objectives. The goal of my programs is to bring professionals together to help them better serve their clients, and this is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not for profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 20 or so events I run every year, I also do a fair amount of writing on the topics of investing and financial planning, and you can read my work in a variety of periodicals, including Barron's, CNBC, Forbes, Kiplinger, The Wall Street Journal, and Trust and Estates Magazine, to name just a few. You can see all my work on my website at parkbridgewealth.com/articles or by following me on social media at Jonathan on Money. Additionally, you can check out my weekly podcast, which is also called Jonathan on Money, and you can listen to that on Apple, Spotify, or wherever you get your podcasts. And finally, I published my first book, D is for Diversification, The ABCs of Personal Finance, which can now be purchased on Amazon or jonathanonmoney.com, and that's a great way to support these programs. Today, we're privileged to hear from Timothy Noonan from Hodgson Russ, based in Buffalo and New York City. By way of background, Tim is a partner and tax residency practice leader at his firm. He focuses his practice in the state and local tax area. His work primarily involves New York State and New York City tax litigation and controversy. Over the past 20 plus years, he has handled more than 3,000 personal income tax, sales tax, corporate tax, or other New York tax audits. Tim also has handled about 100 cases in New York's Division of Tax and Appeals. He has handled some of the most high profile residency cases in New York over the past decade or so, including the 2014 win in the Guyed case, one of the first New York residency cases to ever reach New York's highest court. He's often quoted by media outlets, including the Wall Street Journal, the New York Times, and Forbes, on residency and other state tax issues. As the Noonan in Noonan's Notes, a monthly column in Tax Notes state, Tim is a nationally recognized author and speaker on state tax issues. And today, Tim will be speaking on hot topics in state tax residency, audit enforcement, and wealth taxes. And with that introduction, I now turn the program over to Tim.
Thanks, Jonathan. Glad to be back here. This might be year 10 or 12 or 15 that I've been with you, so I appreciate getting the call back. Hey, everybody. Good to be here. You could also sort of call the topic Tax the Rich. That seems to be all the rage, especially in our favorite states of New York and California and the like. So I'm going to be talking about that today. Really two topics underneath that. One, residency and what's sort of happening in the residency space and what states are doing there. And then second, sort of the other shoe that often falls in these cases, which is non-resident allocation. Even if you're a non-resident of a state, states can still tax you. States can still tax you. So not a lot of time, not a lot to cover. We've got a lot to cover, so let's go. So yeah, first thing is residency, and how states, they're sad when people leave, so they want to, make sure that they really did leave. So, and the reason this is becoming such a big issue, and has been for the 27 years I've been doing this. It's always been an issue, especially in New York, but it's growing post-COVID, and you see on this map, this is people leaving, and like the red, sort of the opposite, frankly. This is from the Tax Foundation. They sort of have the colors backwards, but the red states are states where people are leaving. And the darker the state, the more people have left. And you see our two industry leaders there are New York and California. Well, why are they leaving? Well, here's the next state, also color shaded. The darker the color, the more tax there is. So you can see shockingly that folks are leaving particularly the more redder states. Again, very confusing because they're really leaving the blue states. But I think you get the gist. Although it is funny, you see, go back here, lots of people are leaving Alaska. Okay, great. They don't even have an income tax. So the weather must really be bad there for people to be leaving. Otherwise, I think it's these high tax rates that are causing the exodus. Why is that? So the reason that is because when we think about state taxes, it's really centered on this question of state residency. And it is because actually the math is really simple. If you're a resident of a state, you're only taxed on one thing. Only one thing, but that one thing happens to be everything. You're taxed on all of your income, regardless of its source, if the state deems you to be a resident. If you're a non-resident, you still might have to pay tax, but only on so-called sourced income. So we'll talk about that in a few minutes. But residency is huge. It's also huge, and you won't care because you'll be dead. But for estate tax purposes, it's a big deal. Residency really domicile where the decedent was domiciled at date of death is also a trigger for state estate taxes. So we care about this residency topic a lot, especially in the high net worth states or high net worth clients. So again, then they're also the states also care about these folks too, right? That's the focus of their a lot of their tax provisions and tax enforcement efforts are on the wealthy. There's a stat in New York City, something like the less than 1% of the taxpayers pay more than 47% of all the New York City income tax, right? So you can see why there's a focus on this high net worth set. And what we're seeing across the country again, only in certain pockets is rates going up or new taxes. Like Washington just passed a sort of full regular old state income tax. They had a capital gains tax that they put into place a few years ago. Now they're just a regular old state that's got a tax rate of about 10%. And not shockingly, my phone's been ringing with people wanting to leave Washington. Massachusetts a few years ago raised their tax for sort of so-called millionaire tax to upwards to 9%. And wouldn't you know it, now Massachusetts is doing a lot more residency audits than they used to. And now more people are calling us to move out. So there's been a flurry of activity there. The other thing going on, we'll talk about a couple of these for a second. The California wealth tax. I want to spend a couple minutes talking about that. And all the rage the past couple of weeks has been the New York City pied-à-terre tax and videos by the mayor outside a taxpayer's apartment, naming that taxpayer, which you're kind of not supposed to do that. But I'll talk about those too. But the idea is states are sort of trying to get more creative, and there's no better example of this than what's going on right now in California. So in California, again, it's been in the news probably since around Thanksgiving last year. There is a proposal. Now, it's not a proposal by the governor or by the legislator, by the legislature. It's a ballot measure because in California, that's one of the ways they make new law. You can just get something on the ballot and leave it to the masses to vote for it, which is kind of nuts, but they can do that, and they have all sorts of ballot measures all the time in California. Well, there's a ballot measure percolating right now that's designed to establish the first of its kind tax on wealth. So not an income tax, but just a tax on wealth. Now, you might say, big deal. It's targeted at billionaires. And the California proposal back in October, November 2025 indicated that there were something like 260 billionaires in California. I might encourage them to run their math again because in May of 2026, I don't think there's 250 billionaires in California anymore because of this proposal. Lots of them are leaving. Lots of them have left. And the issue here is California is saying that if you were a resident as of January 1st, 2026, again, the law isn't even in existence yet. It won't come into existence until possibly November of 2026. But never mind that. It looks back retroactively, say, if you were a resident on January 1, 2026, defined under the California residency rules, then we're going to tax 5% of your wealth above $1 billion. So, again, it's not like this wide-ranging tax that's going to apply across the board, but it's getting a lot of attention because it's the first of its kind. No state has ever imposed a wealth tax. States like California have been kicking the tires on it, but no state's ever done it. That's unusual. It could very well be unconstitutional. That's why no state's ever done it because you can't tax wealth. You can only tax income. So look, we can expect lots and lots of challenges. This act is certainly generating a lot of work for lawyers, both in terms of folks like me who move people out of states and other attorneys who might sue to get this thing overturned. So what's happening is they have to get enough signatures to get it on the ballot. They've gotten enough signatures. And sometime in the next, I think by the end of June, we're going to know if it's going to be on the ballot or not. And then it's got to pass, but it only needs 51% of the vote to pass. So like it only affects 200 people. or maybe not 100 people. But who's gonna, I don't think the sort of masses are gonna vote against this. Now there are, interestingly, because California is crazy, like competing ballot proposals, and basically there's like a ballot proposal that said you can't have a wealth tax. So it could be whichever one wins. But again, the fear is that this thing's going to pass, and who knows what's going to happen. It's going to be tied up in litigation for years. Interestingly, the governor doesn't want it, right? So the governor of that state does not want it. He thinks there's other ways to go about it. I think rightly he sees the fear and the exodus from important taxpayers who pay lots of money. There's studies that have been done since this came out to show like California, you might get a big slug of cash if this passes in 2020 for 2026, but half of the billionaires who left aren't going to be paying you income tax for the next 20 years. So it's probably a bad thing. So in any case, look, other states are watching this because what happens in California often starts to bleed into other states, including New York. So again, New York doesn't make our law via ballot measure, thankfully, but there's chatter about it from different folks in New York about doing something similar. So I think it's just a fear that this could be coming to a state near you if it passes in California, and it's really kind of a game changer. Again, no state has ever done anything like this. Not so much of a game changer, but also, again, an example of sort of this tax the rich idea. And that's not really coming from me. The mayor of New York City said that in a video a couple of weeks ago that he was taxing the rich, and this was one of the ways he was going to do it. So the idea is to impose what's sort of been called a pied-à-terre tax, which is on all of those people that I helped move out of New York to Florida or other places who kept a place in New York City. They're saying, well, since if it's your second home, we're going to tax it higher. We're going to impose a much higher real estate tax on you if this is your second home. Now, full sort of clarification here: this is not the pied-à-terre tax that's being bandied about, or it might be. We just don't know. There's all this chatter about a potential tax over the past couple of weeks, and the thought is it's going to look something like the old version that's been bandied about, and this was the most recent version bandied about, basically a 4% tax on places valued more than $5 million. But again, if you have if you have a $10 million place, you're going to pay 4% tax on $5 million every year. Like that's could be worse than an income tax, right? That could be. I'm no accountant. I think that's like couple $100,000 in tax every year just for having a place. The math for co-ops and condos is funkier because the way those things are assessed and appraised is different. The tax rate is 10% above $300,000, but it's weird because I think if you have a $50 million co-op in New York City, it might only be sort of valued for appraisal purposes at I don't even know, $1 million or something. I'm not sure how that math works, but those are things that I think they're working through. It won't apply, and this was in the prior proposal, but some version of this will probably be in the new proposal. I mean, it won't apply if it's your primary residence or if you have a kid who lives there and it's the kid's primary residence. It won't apply if you're a landlord and you're renting it out to a primary resident, although are they going to require landlords to then prove if their tenants are primary residents? I'm not honestly sure how that would work. But in any case, this is out there. And again, causing a lot of consternation for folks in the city, or I should maybe say folks in Florida who have places in the city. So that's what's going on there. In terms of enforcement, it's kind of an interesting state of play here. New York obviously is super aggressive. They have hundreds of auditors. They do thousands of these audits a year. They collect billions. So it's a thing in New York. It's a whole industry. I have lots of clients who contact us about moving, and I can pretty much tell them based on their income level if they're going to get audited. Sometimes like down to like the month, and maybe that it's not that exact, but if the income is over $1 million, there's likely going to be an audit. I think that threshold might be going up a bit. It's just sort of just in terms of so many people moving. There's only so many auditors to audit those people. So I think the threshold is up a little bit. Maybe it's $2 or $3 million. So if you make, $800,000 and you move to Florida, I mean, that's great and good for you. You might save 80 grand in tax. You're probably not going to get audited because they just can't chase after everybody. You make 10 million bucks and you move, saddle up. Like there's going to be an audit. So that's the state of play in New York. Other states, they kick at it, they poke at it. California certainly is there. They don't audit with the same zeal as New York, honestly, but they do, and they're there. Connecticut is also fairly aggressive. They're a smaller tax department, but lots of folks have left California. We also see sort of a lot of kind of overflow from like New York audits. A Connecticut person gets audited in New York. Maybe they're not still a resident of Connecticut, but they have to allocate more income to New York. So they go back to Connecticut and say, "Hey guys, I paid more tax to New York. Can I get a refund?" Connecticut doesn't like that very much, so they're going to do an audit of that. So that results in a lot of Connecticut audit activity as well. Then, the rest of them, it's just kind of random. I mentioned before, we're starting to see more Massachusetts enforcement activity, again, because the rate has gone up. So it's more there to audit in Massachusetts. Washington, maybe. They've had a capital gains tax for a few years. Now they have an income tax. Again, we're probably going to see some enforcement there. Then we have states like New Jersey, which has a very high income tax. And they have a regular old sort of tax department. They just really don't focus on residency. So you have folks who leave New Jersey, they move to Florida. They keep a place in New Jersey. They spend a lot of time in New Jersey. They're just not getting audited. I don't know why. I haven't sort of seen it though in 27 years of practice. I don't see New Jersey chasing after people. But they might. So we got to be careful. And they have the same rules as New York. So typically when we have a New Jersey person, we're like, all right, I don't know what's going to happen in New Jersey, but if you follow the New York rules, which are the same as the New Jersey rules, we're going to be okay. So at least that's the kind of game plan we set. Okay, cool. A couple other things, just a few cases that have come out in different states. Just want to give you sort of a flavor of what's going on in some different states on this residency topic. So, first case is a case that came out like last fall called Hoff. Folks claim to move from like, kind of actually the Western New York area down to Naples. It's kind of like a weird case to litigate, honestly. The residency, there's two residency tests. One is really black and white. If you spend more than 183 days in New York, in this instance, you're a resident. But even if you're under 183 days, the more important test is this concept of domicile, where your permanent home is, where your primary home is. So when I have someone moving to Florida, a lot of, most of my advice is around questions of domicile. How do you prove that Florida has taken over as your permanent and primary home? And when you do that, how do you prove it so it's clear? Because if it's a close call in these Florida move cases, we're going to be in trouble. So if you have a client who's like, "Oh, I'm going to spend 6 months in a day outside New York and change my driver's license, and I'm not going to be a resident," it's like it's not that easy. That doesn't Doing those things doesn't actually go that far to proving that Florida has become your permanent and primary home. You have to compare your housing in both places and maybe have a nicer and more expensive place in Florida. You got to look at your business ties in both places. You got to look at where your stuff is and your art and your precious possessions and things like that. Where's that stuff? These are the things that matter. And the thing that matters the most, actually, in these cases is where someone's spending their time. Because that's if we're trying to determine where someone's primary home, primary domicile is, well, a good marker for that is where you're spending your time. So in this case, these folks, you know, they did the 6 months in a day thing. They weren't over 183 days, but they ended up spending more days in New York every year than Florida. It's not good. It's not good. And then that leads the judge down to other roads like, oh, they had country clubs in New York and, looked at other things. And it's just, but ultimately, it's kind of hard for these folks to prove that they changed their domicile to Florida by clear and convincing evidence, and they really did it when they ended up spending more days in New York than Florida. It's just really hard. The other lesson here is that if you litigate one of these cases in New York, there's the administrative law judge who issues a decision, which happened here, that decision gets posted on the internet, and then that is free for everyone to look at. I mean, what happened to these guys is it wasn't even that big of a case, but somehow it got picked up like by Bloomberg. The New York Post got a hold of it and just had this whole spread on these poor folks about, oh, they were on their yacht. There's a pictures of like the wife from Facebook or something, like sitting on the yacht with a drink with the little umbrella. It's just not good. Like, so you got to be careful too. If you're going to litigate, you got to kind of want to be sure you're going to win because you don't want that splattered across the news everywhere. Connecticut had a case a little bit sort of similar to the Hoff case. It's an estate tax case. So the question was where the decedent was domiciled. Has a little bit of flavor of the Hoff case. And the court sort of went through the domicile test. Again, the taxpayer was under the day count. I think they spent 100 and, he spent, 170 days or something like that a year in Connecticut. But he only spent 120 days in Florida every year. He did all the things like the driver's license and the voter and all that sort of stuff and changed his addresses. But the judge was like, man, I just don't think that's enough. And I like the way the court put it. It's right on the slide here. It looked to, where the taxpayer chose to spend his most valuable and limited resource, his time, right? So where the taxpayer spent his time, and that's where the focus was in this Daniels case. Lastly, again, probably the third state where we see a lot of the action here is California. This is 2021 California case. This is a good case for the notion that sometimes the issue isn't whether someone moved, and these taxpayers claim to move from California to Nevada. And California, the appeals court here agreed that they did move from California to Nevada. It wasn't a question of whether they moved, it was a question of when they moved. They claimed to move in February 2008. They had a big gain in July 2008. So naturally, California, and by the way, they sort of, in September of 2008, that's when they sort of honestly looked like they kind of settled in to Nevada. In February, they did all the things, the driver's license and all that sort of stuff. But one of the problem was, again, banging on the same theme between July 2008 and February 2008 and July 2008, they were in California a lot more than they were in Nevada. So California says, again, we agree that you moved, but not until September. And oh, darn it all, you had a big gain in July, so we get to tax all that. So again, when someone moves is a huge part of these cases. And a lot of times when folks are coming to us for guidance, it's because they have a big transaction coming up or something like that. So sticking to sort of the landing, hitting the target, and doing that before the big income event during the year is massive. So that's super important whenever you're sort of planning a move for folks, is to focus so much on the timing of it in order to make sure you get out before you have that big income event. Okay, so let's assume we're out. We're not a resident. Awesome, good for you. Non-residents still pay tax on sourced income. So that's like wages from services performed in the state. If you sell a building in the state, obviously that's going to be sourced income. Also, business income, flow-through income from an S corporation or LLC. That's going to be sourced income. Non-residents don't pay tax on sort of so-called unsourced income, or investment income, interest, dividends, capital gains, carried interest from the hedge fund or private equity world. That's typically not deemed to be sourced income. That's more sort of investment and tangible income. The issue is states are sort of looking at intangible type income now too. We'll hit a couple of those topics in a second to sort of say, well, it looks like an investment income, but we still think it could be sourced income. So a couple special things just to talk about on the non-resident allocation piece. First is the beloved convenience of the employer rule. That really is a New York thing. About 6 states have a rule like this. During COVID, like 15 states created a convenience type rule. The idea is sort of around remote work. Normally, if you're a W-2 wage earner and you're a non-resident of a state, so you live in Connecticut, let's say, and work in New York, you're going to pay tax to New York based on the number of days you work in New York. It's pretty simple math, right? The numerator is days worked in New York. The denominator is total days worked in the year. So that's a simple concept. New York has a twist. It says, well, look, if you're working remotely, if you're working from home for your own convenience and not out of any employer necessity, we're going to treat that as a New York day as well, even though you're not physically present in New York. And over the years, that sort of convenience necessity distinction isn't really all that relevant. New York would say if you're working from home and your employer is in New York, we're going to treat it as a New York day. Like that sort of by definition is convenience. If your employer says, hey, go to the ABC company down the road in Connecticut and have a meeting with them, okay, that's a Connecticut day. But if you're working from home, even if your employer forces you to work from home, New York has said that's a convenience day. And this is naturally sort of exploded since COVID, this issue. And there's litigation right now. The Zielinski case is one case. The Myers case is a case we're handling, another case. These are cases where during COVID, the employee was forced to work at home because in the Zielinski case, the governor closed the guy's office. Like he worked for a law school, a school in New York. Governor closed the school. He couldn't go there. In the Myers case, it was a bank. The bank closed their doors for a year and a half. These employees could not actually go into their office, and yet so far, New York's Tax Appeals Tribunal, which is like the New York Administrative Court, has said, no, sorry, those are convenience days, even though you couldn't go into New York. I don't. These cases are now in the appeals court level. I mean, I'm a hopeful guy. I sort of think the courts are going to sort of see some reason for that. And if the government or the employer closes the office, it can't be a convenience day. Otherwise, of course, thank God COVID's over. The convenience rule is still out there, right? So you still have the situation where if you're working remotely for your New York employer, you might have to pay tax in New York. So you move to Florida, but you keep the same job and you work remotely because you can. You got to be careful. So there's ways around it. If your employer assigns you to a different office outside New York and that becomes your primary office, convenience rule could not apply. There's a way to create a bona fide office of your employer in your home. So that's steps we've taken with employers and employees to do that. If you never go to New York at all during the year, there's no convenience rule either. It's sort of the cold turkey option. So there's ways around it. But again, this has become a big deal, really post-COVID, since remote work is still kind of a big thing. Okay, so last two topics, just to hit them quick as I have a couple more minutes here. First, we talk about sourced income. So let's say you're a partner of a partnership, or a shareholder in S corporation, and that entity is doing some sort of business in New York. You're going to pay tax, but instead of paying tax based on where you are or based on sort of the workday method that employees use, it's actually going to be based on where the company is. And when you determine that, it'll be based on the company's allocation percentage. So not based on where individuals are working. So for partnerships, and again, this is my New York example, partnerships, the ordinary income of a partnership gets taxed based on the partnership allocation rules, which is sort of an arcane sort of three-factor formula where they're going to look at where the property of the company is, where the payroll of the company is, and then essentially where the primary office of the company is. That's called the origin rule for sourcing. So that's the receipts factor. So normally, let's say you have a company that sells sneakers, and the facilities in New York, the all the employees are most of the employees are in New York, and the main office of the company is in New York. What's the allocation percentage of that sneaker company? Even if, let's say, 90% of their sales of sneakers are to people across the country, that percentage is going to be like 100% or pretty darn close to it. Because if all the property is in New York, all their payroll is in New York, and all of their sales originate out of New York, the partnership rules say we get to tax the whole thing, which is insane. If you're an S corporation, it's vastly different. So if you're a non-resident shareholder of an S corporation, same kind of company, sneaker company selling across the country, it's only one factor. So there's no payroll factor, there's no property factor. And we're only looking to where the sales go to, destination based. That's both for services, so-called market-based sourcing, and for sneakers and things, destination-based sourcing. So in that example, if you're an S corporation, your allocation is going to be like 10%, if you're a non-resident. So that is such a huge thing, but especially a lot of states have kind of consistency between how partnerships and S corporations and LLCs or whatever are taxed and are allocate how they allocate income. Not so in New York. It gets really complicated. The other thing, just to close here, if you have a non-resident selling business assets, well, that's the result there is going to vary. And again, a lot of times we're approached by people who are moving and that they want to move to Florida because they're selling their company, right? Well, if it's an asset sale, the gain still could be taxable based on that company's allocation percentage in the year of sale or in the couple of years before the year of sale. So you got to look at that. If it's an asset sale, there might not be a lot of savings. If it's a stock sale, well, then you'll get your savings. That'd be great. The problem is if it's a stock sale, so-called stock sale, that's treated as an asset sale, either in the S corporation context or sometimes even in the partnership context, if the buyer gets a step up in basis, New York at least will say, we're going to tax that as an asset sale too. So just to watch out for that, if you have a non-resident or someone a resident who's moving before the sale of a business, be super careful. You have to look at the not only the sourcing rules, but again, you have to focus intently on the difference between a stock sale and an asset sale. That's it. Wild and Woolly, guys, 30 minutes. We sort of gave a good summary. All my contact information is there. You guys, anyone have questions, feel free to give me a call or shoot me an email. I'm happy to answer any of them. Jonathan, back to you.
Great. Thanks so much, Tim. And if anyone has any specific questions, new business opportunities, or any other issues they'd like to discuss, please feel free to reach out directly to Tim or myself where appropriate, and I'll be sure to include his contact information in the follow more quick items before I let you go. First, my next webinar is on Thursday, May 28th at 8:30 a.m. on designing resilient estate plans, planning to avoid litigation, featuring Asher Lowenstein, founder of Lowenstein Legal, based in Long Island, New York. And I'll be sure to send out the invitation to this program in the coming days. In the meantime, if you have a friend or colleague who'd find these webinars of interest, they could subscribe to my webinar distribution list on my website at parkbridgewealth.com/webinars. Second, you can follow all my work on X and Instagram at Jonathan on Money, and by connecting with me on LinkedIn. You could also listen to my weekly podcast called Jonathan on Money, which is available on Apple, Spotify, or wherever you get your podcasts. And you could watch my practical planning videos, which I post several times a week, by following me on YouTube at Jonathan on Money as well. And third, please take 30 seconds to fill out my survey at the end of this program. It helps me improve my webinars and provide timely and interesting content to attendees, and I thank you in advance for that. And with that, this concludes today's session. Please stay safe and healthy and have a wonderful day, everybody.